The evolution of token offerings and regulation across Europe.
Good morning and welcome to this session about the evolution of token offerings and regulation across Europe. Today I'm very happy to have with me an old friend, Yael. I've been knowing Yael for many years now, and she's certainly one of the biggest experts in tokenization. And we also have Alex from the UCLA blockchain lab. I'd like to learn more about what you do as well during this session at the UCLA blockchain lab. It sounds very interesting. He's the co-founder of the blockchain lab. So without further ado, I'd like to start with a very general question in line with the topic of this panel. So 2016, 17, and 18, we've seen a lot of token offerings. It was, let's call it the gold rush. And things have changed a lot since then. How have token offerings changed over the past years? And maybe you would dare to give us the reason you think they have changed in this way?
I can start, Joseph. Thanks for having me on this panel. I'm really excited to be with you again, even though it's not physically in Malta. So hopefully next year. So we've seen an evolution in this tool that's called blockchain and cryptographic method of recording the cap table of ownership on the blockchain. We've seen the evolution of using of this tool for fundraising from the ICO to an STO model. Now, the predictions around the STO has really filled a gap in the market. The predictions for its growth were tremendous, right? Because in reality, up until now, companies and assets only had two ways to raise money: either private investors or public. Right? Public market. Big companies can, of course, go out and issue corporate bonds and get loans, but smaller companies and assets like real estate, for example, do not have such an option usually. So there was a lot of excitement. Finally, we have this approved methodology to raise funding and to maybe leverage assets that we have and get some liquidity and then go out in the market and do interesting things. So there was a lot of prediction around, the ICO market just moving towards the STO. Now, we didn't see that happen necessarily in 2018. 2019, it did pick up to some good levels. We've seen over $3 billion issued in security token offerings worldwide. Most of them were in either real estate or funds, equity funds that were tokenized. What we've seen, Joseph, is that big funds have preference towards tokenization. Why? Because they can afford it. It's a very expensive process right now because of legal and compliance costs primarily. So that's why right now only big organizations can afford to tokenize. And that's not what we want in the market. We want to see streamlined approach, proven methodology, very transparent and non-opaque regulation around fundraising. Now we're going slowly towards that, and we've seen quite a few STOs happening in 2020, even through Corona, which is great. So, if we take concrete steps towards more transparency processes and standard methodologies for STOs, we're going to see a huge growth in the coming years.
Thank you, Yael. Alex, what are your comments about this?
Sure. So we went through this rabbit hole of the transition of ICOs to STOs with a lot of detail. We started the UCLA blockchain curriculum back in 2017, and very early on, we saw that most initial coin offerings, like we like to say here in the US, smelled like a security, walked like a security, talked like a security. Most likely it was a security. And we went down the path as an institutional player, an investor, as well as a university, to figure it out how to issue regulated token offerings, which I invite everyone to take a look at. How is it we're going to do this? Maybe. There we go. Yeah. Take a look at our book. It's the book we use at UCLA. And it talks about like how to issue security tokens around the world. But the essence of the change and dynamics of the market, it's simple, right? The SEC, which is the Securities Exchange Commission here in the US, controls and regulates 40% of the global trade of equities and bonds. So if any kind of token offering was going to catch momentum and it's going to do everything that it has the potential to do, it would be if it would be adopted by institutional investors and players. And no institutional investor and player anywhere around the world is going to play with a quasi-security that the SEC deems as an unregulated securities offering. So we've been seeing that transition after the Dow scandal into 2019, when the SEC allowed not one but two security token offerings as a public offering under what we have here as a Reg A+, the props token, and Blockstack. And since then, we've been seeing a lot more flexibility by the SEC and other regulators around the world into tokenizing securities or issuing security tokens. Some people make distinctions on what a security digitized would be a security token or not, but nevertheless, the point here is how to tokenize an asset and issue it on a blockchain.
So we all agree that it's finally time for asset-backed tokens to take over, right? And however, although we've seen a few, I still believe that we're still far away from what the potential of this could lead to. I'm seeing very few reputable or at least mainstream security offerings in terms of asset-backed tokens. So unfortunately, most of them are still quite low-key, and there are very few options of how to trade them. So how is this going to develop over the next few years, in your opinion?
So I can address the distribution of tokens and the availability of tokens in that whole market. So one of the remnants of the ICO market was the listing on exchanges and the exuberant prices that all the crypto exchanges required for listing, right? Which are already coming close to even IPO prices in some cases, right? So what we need in order to distribute and to facilitate the secondary market are, number one, secondary markets that have liquidity and that have users. Number two, affordable ways for assets to list themselves there, right? We're doing a private offering, not a public offering. If you're looking at a regular exchanges, just traditional securities exchanges like NASDAQ, NYSE, Malta Stock Exchange, they all have a private placement platforms, right? So where you can, for a few $100s, maybe a few $1,000s, list your assets for trading. Now, it does not avail you liquidity. It does not avail users because smaller market caps, smaller project market caps are not expected to trade as larger market cap companies. So what are we going to do, right? So there are different ways that SolidBlock is overcoming this liquidity gap. Number one, by partnering with traditional exchanges and creating an infrastructure and technology through which we can facilitate token transfer between various exchanges, right? So global interoperability, global liquidity. And the second way that we're doing that is by aggregation of smaller projects into larger indices. So thereby increasing the market cap. Now institutions could be interested, but also by placing projects on exchanges, we're now enabling the investors to buy these securities just through their private bank, right? As they would any project that's listed on an exchange. So we're overcoming the trust gap, right? Because even though, SolidBlock was the first company to tokenize a commercial real estate asset with the St. Regis asking point, most people still don't know about us. But people know about Nasdaq, people know about NYC, people know about Malta Stock Exchange, people know about Tel Aviv Stock Exchange. So that's my advice to the industry, is to actually, you're dealing with a regulated space. You need to gain people's trust, use traditional channels to get to investors.
Alex?
Yeah, I think that we're in a transition, right? If you really look at how old security tokens are, they quasi started in 2018 with a lot of promise. But over our research, we identified that there are two main hurdles. One, which Yael mentioned on, which is the technology interoperability and finding a standard that everyone around the world is going to use from a tech point of view. And I think that that's being solved. We have things like SolidBlock, who's doing a fantastic job from the beginning of the industry. We have more traditional players that are now entering the industry with full-fledged solutions, like Nasdaq offers a full security token solution from 0 to 100. But then you have another roadblock, and a roadblock that is historical in securities trading around the world, which is local jurisdiction. Right? We haven't yet in the history of securities seen a harmonizing global regulatory framework that would allow me to easily change a security or exchange a security from a Japanese security holder with a Brazilian security holder. Those things usually go through clearinghouses and transfer agents. And I think that's one of the issues we're facing today. We're solving the technology with great companies like Nasdaq or SolidBlock, but we're still in the midst of figuring out regulatory frameworks that could help transition assets from one market to another, which is really where you're going to get liquidity. And then as a final point to that, we're in the transition, like Yael mentioned, of a consumer behavior. Traditionally, crypto investors are prone to risk, but they don't want to take a picture of their passport. They don't want to upload and do KYC and get on white listings. And they're traditionally different than your usual, more senior or institutional investor who's accustomed to doing that. So I think that there's those three things we're getting over, those three hurdles, with technology being one that's being greatly solved by innovators in the space like Yael and her team.
Very interesting points. I have, so when I was doing my Oxford University FinTech program, the project, my basically the final project I had to do, I chose the topic of P2P lending platforms, and my project was based on the use of tokens, of security tokens, of tokenized assets as collateral. So I see, for example, art as being something that can be easily tokenized. So you have a Caravaggio painting or a Michelangelo sculpture, and it's tokenized. It will still be exposed in a museum, but the ownership of it would be in the hands of the community, of the people that buy into it. And with that money, the museum can actually fund itself in order to maintain these pieces of art. Same with real estate. Obviously, real estate is also easily tokenized. I can buy a share in a shopping mall. I can buy a few tokens in a shopping mall without needing to own the shopping mall. And that's also another idea. And if I have those tokens, I can use them as collateral against the loan that I get from another person. So you don't need to go through the whole due diligence process in terms of whether the person who's borrowing the money has the assets to cover that money. And then it's easy to have an agreement that if the value of that collateral falls below a certain threshold, that collateral will be automatically sold, and the money will go to the lender, and the remaining part will go to the borrower or against fees of the platform. So that was my project for the Oxford University FinTech program. And I really believe in it. I really believe that this is the future, especially with banks becoming always more difficult to give loans. What do you think? Do you share my view that that is something that is going to happen anytime soon?
We still have to tell Alex, follow up his answer. Thank you for all the compliments.
My pleasure.
In terms of the loan and STO connection, I believe that the DeFi market, decentralized finance loans specifically, will be what will catalyze the whole STO market. I believe we can use the DeFi mechanisms to underwrite STO projects and then turn around and list these projects on exchanges and also, primary and secondary market, and repay the DeFi loans. That's actually the mechanism that we're developing right now, working with several DeFi companies. It's looking very, very promising. But I'll tell you about a few challenges that we're facing. Again, challenge number one is this ICO mentality and non-real world asset mentality of we need to have a community, right? So one of the measures for the DeFi market of the success of the asset is how many followers it has, how much liquidity, how can they predict liquidity in the asset. Now, the real world assets like art, museum, or real estate are not expected to have a lot of liquidity. These are more of a long-term hold assets. And in some cases, you expect liquidity right after a certain milestone, where we expect the asset to go up in value. And thankfully, in real estate, those milestones are abundant. When you complete development, or when the asset opens to public, or when there is a report on how well the shopping mall did, in the previous quarter. You have all these milestones where we expect the value to go up, and we expect for people to want to cash out. So we need to kind of overcome this mentality from the crypto world and crypto assets that are based on either expectation of growth, like Bitcoin, or possibly some sort of applications or blockchain applications that are being built based on a certain token or stablecoin. So that's one market. Our market, the STO market, is actually the real world asset market. It behaves differently. It behaves similarly to traditional companies, but on a smaller scale. So my answer to your question is that the loan connection to the STO is probably the most important connection and direction in the security token market.
Alex, before you reply to this, we only have a couple of minutes left, so I'd like you to be short, but I'd like also a comment from you, apart from this thought that I threw earlier, a comment about MiCA. So basically in September, the European Commission published a wide-ranging digital finance package. Part of it is the markets in crypto assets regulations. They look into regulating token offerings and services relating to crypto assets. So crypto asset services. I'd like a very short comment from you about it. What do you think, if it's a step forward or if it is just adding more hurdles for tokenization to take over in this space?
Yeah, no, that's very interesting, and it was very forward thinking by the European regulators to come up with that paper. I think that paper is about like a year or more until it becomes implemented, but it's a solid evidence of our theory that if tokenization is really going to take all the opportunity to be one of the greatest financial disruptors in the history of finance, is that if it gets institutional adoption. And no institutional player, no bank, no major hedge fund, no pension fund in the US or abroad is going to invest in anything that is not regulated. It's just simple like that, right? We might think about revolutionizing the financial industry. It just won't happen if it's not regulated. It's just point blank. That's the reality of things. And then the MiCA proposal is very interesting because it not only proposes to create a framework for regulating things like stable coins, regulating things like security tokens, regulating even things like utility tokens, as long as they don't pass a threshold of €1 million or 5 million euros in market cap. They're like small, or they can't be traded one for another. Another very interesting piece of evidence in that filing was that existing players that are already licensed, like credit unions or insurance companies, wouldn't have to get licensed to hold these assets. So right there, you could see it as a gatekeeper, which will keep, the rich getting richer. But at the same time, you get institutional adoption at a flick of a finger. And we're seeing that also happen here in the US. Recently, the US government announced that retail banks are going to be able to custody crypto. So whenever our parents here are going to be comfortable in holding crypto in their retail bank and security tokens, I think that's when we're all going to see the huge boom we've been all waiting for in the tokenization space.
Thanks, Alex. Thank you, Yael. It was a great panel. And thank you all for following us. On to the next one.
Thank you.
Thank you so
Joseph.
much for having us.
Thank you.